Good morning. Today is Wednesday, June 23rd, 2021, and welcome back to the Market Commentators podcast. I am your co-host, Jake Wilms, a quantitative analyst with the Milwaukee Company, and filling in for Andy Wilms today is Michael Curran, wealth manager at the Milwaukee Company. We work closely together. Happy to have you on the show, Mike. Welcome.
Hey, thanks for having me, Jake.
How are you doing today, Mike?
I'm doing pretty well, can't complain.
All right, glad to hear it. I am doing well myself. Excited to talk to you today about low risk investments that generate higher than expected returns. But before we get started, please keep in mind that this podcast is for informational purposes only, and that the views expressed in today's podcast are mine and Mike's personal views and not those of the Milwaukee Company. So, Mike, we've kind of gone down on a limb a little bit this morning and telling listeners that we're going to give them ways that can earn high returns without a lot of risk. And I will let you lead off with that tall task. What is the first idea we've got?
Well, the first idea would be under the fixed income category, more specifically the Series I savings bond. And this is a non-marketable interest-bearing U.S. government savings bond that earns a combined fixed interest rate and a variable inflation rate that's adjusted semi-annually. The bonds are meant to give investors a return plus protection from inflation and, protection on their purchasing power. Series I bonds are considered low risk since they are backed by the full faith and credit of the US government, and their redemption value cannot decline. So you do not lose your principal and it goes up with inflation. The interest earned on the I bonds is tax deferred until the bond matures or until it is cashed in. Plus, it is exempt from state and local taxes. And even better, if you sell an I bond and use the proceeds to pay for qualified higher education, the expense is exempt from federal income tax.
Wow, that's a lot of benefits. So it sounds amazing, but I have an inkling that there's a catch behind these, and what might that be?
Well, unfortunately, I bonds aren't an all you can eat buffet. They hold a maximum purchase of $10,000 per calendar year. So you can cash them after 1 year, but if you cash them before 5 years, you lose the previous 3 months of interest.
Okay, that makes sense. So essentially, this is a low risk or higher than usual return for a fixed income instrument with a limitation on how much you can invest.
Correct.
So now that you mentioned inflation protected and an adjusted rate, how might these compare to tips? Because I know that's another fixed income alternative that people have been flocking to, especially recently amidst a lot of the inflation talks going on.
Yeah, the big difference between the two is, tips are very marketable. You can sell them whenever you want, and I bonds, you can't really do that unless it's a year out, and you have to sell it back to the U.S. government. I think that includes like the liquidity of them, and then also there's only you can only invest $10,000 per calendar year for I bonds. For tips, you can do as much as you want. So that's the big two that are really interested in those two fixed incomes.
Yeah, I think that makes a lot of sense. I would say though that it seems like the combination of the two would be quite powerful, especially since they have a little bit of a different design and I bonds being not so marketable, you may want to hold those for a longer term. I know the lifespan are quite different, right?
Yeah, I mean, I think tips, they sell for 5, 10, years, 30 years, but I bonds, they only do for 30 years. So there's going to be a lot of longevity for those investing. And like you mentioned earlier regarding, a good combination between the two is always an attractable investment.
Now, I've got one for you, Mike. This one is a little bit more of startup capital. We're going to be talking about single family rentals or SFRs. This is an emerging asset class that's taken the rental real estate market by storm as of late. SFRs, if you aren't aware, they are about a third of all the rented housing units in the US, and they have a combined market value of about $5 trillion. So there's a lot of money in these, and they are getting really popular because you're starting to see institutions move in to this market space. Predominantly, it has been dominated by the likes of single investors or just families or small investing groups. But now you have BlackRock, for example, making big headlines by being very public about the fact that they're trying to buy as many homes as possible.
Yeah, definitely. So, I mean, it's so interesting because now I'm, in that process of looking to purchase a single family home. And, that it frustrates me to possibly be in a bidding war with a large institution.
Yeah.
And, that can drive up the price.
Speaking of price, there's two things I really could take into account what you're going to get from a return for owning one of these. There's the rental yield and the house price appreciation, and they're very different. Like for one, what you're going to be obviously charging the rental is going to be stable income that you can expect. And then while you're getting that income, you can hope for the house price that you paid to appreciate. And you're going to be kind of double dipping in a sense with this sort of investment. Not only will you be able to start to chip away at that upfront capital you had to pay for buying the home, but you may even be able to sell the home for more than you paid for it down the road. And it's interesting that some researchers have taken a look at where the location matters and how it affects these two pieces of the pie. And it's actually believed to be negatively correlated together. So if you have an area like, for example, a high price city where your homes are really expensive, you're probably going to be accruing more of your gain on the investment on the capital side of it. So what you're going to be selling it back for later. But in the lower price cities, it's kind of the opposite effect. You're going to gain more from the rental yield than you are from actually the purchase of the sale. So it's a really interesting area that I think is getting a lot of talk right now, especially amongst like the younger investors. Look at you as a good example.
Definitely.
You're at that stage in life where you're looking to buy a home and you're running into institutions. It's something definitely to keep in mind, and it's another area that I think people should at least look into for another avenue for a lower risk, higher return option.
Definitely.
But we're going to keep it short and sweet today because I know if we went on too long, Eddie would be jealous because he misses the podcast, I'm sure. And we're going to wrap it up here. And thank you for listening to our little shorter podcast this week. Please keep in mind, though, that you should conduct your own independent research before acting on any of the recommendations, information, opinion expressed during this podcast, and that you should not act on anything until you've discussed it with a qualified financial professional who is familiar with your personal situation and investment objectives. So, with that being said, thanks, Mike, for coming on the show and filling in for Andy. It was a pleasure having you. And we will hopefully see our listeners next week.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.